All right, so we're now into the second half of the course. And so the first topic that we'll take up in the second half here is looking at the social insurance programs and public assistance programs. We'll dive into these different types of programs. And the first program that we'll look at is old age survivors insurance. This is the formal name given to our Social Security system. And so we'll take a look at the basic eligibility structure. We'll take a look at how benefits are figured. And then in the last part of this discussion, we'll take a look at the financing challenge, which I think is probably the biggest policy issue in this area. And then in the second part of this lecture, we'll dive into public assistance programs, and namely, we'll look at temporary assistance for needy families, which is the name of our formal welfare system. That's the federal name. That's that's the name of our national program. And so we'll take a quick look at the history and talk about the purposes and some of the conditions that adhere in the program, and maybe not so much about the outcomes, but just a basic discussion about these two programs. So behind me, you'll see the Social Security Act of 1935, as it existed in 1935, all the different provisions, and then also as it exists in 2014. You'll notice Title I, back in 1935, it says OAA, which stands for Old Age Assistance. Old Age Assistance, as the title would suggest, was a public assistance program that was basically merged in the 1970s into Title 16 as part of Supplemental Security Income. Supplemental Security Income merged Old Age Assistance. It merged Title 4B, the section on crippled children or kids with disabilities, and then it also merged Title 10, which is Aid to the Needy Blind, and that became SSI, what we now know as SSI. And then you'll notice Title II is OAI, or Old Age Insurance. And so this is the same title today. When we talk about Social Security, Social Security is still Title II, but we have an S here. There's an S, a letter that was added, an S and a D. And so the S is denoting the survivors component, which was added in 1939, so 4 years after implementation of the Social Security Act. And then the D, the disability component, was added in the 1950s. And so just quickly going through, so Title III is still Title III, that's still, it was unemployment insurance back in 1935, and it's still unemployment insurance today. And then Title IV-A, you'll see here ADC, that's Aid to Dependent Children. That was the very first name given to our welfare system. And so Title IV-A, the name has changed, but it's still the same welfare system. We have TANF, Temporary Assistance for Needy Families. We're looking here at Titles II, and Title IV-A is what we're examining in this lecture. So first, Title II. This is old age survivors disability insurance. As the name would suggest, there are different categories of persons who receive benefits under this program. There's an old age component, there's a survivors component, and there's a disability component, all with different eligibility requirements, and also the benefits are different. And so we'll take a look at some of the basic features here. So I just want to remind students that recall that this is a social insurance program. And so in the last part of this course, we talked about the characteristics of social insurance programs, that they're universally available, right? We talked about universality, that anyone could potentially benefit as long as you've made the required contributions, and that's the case with Social Security. Of course, that means it's not means tested. You don't have to be poor to receive Social Security. Anyone could potentially receive Social Security benefits. And then, of course, the financing for Social Security is going to be our social insurance. And Social Security also is going to be different from our welfare programs. And then, of course, we talked about issues of adverse selection and moral hazard that are overcome by organizing a program around these social insurance principles. This is a quick poll. This is a poll taken by the New York Times, asking people about their thoughts about Social Security. And so basically, they're asking, so when you turn 67, when I turn 67, what's your expectation is what they're asking. So do you expect, in the case of answer choice A, do you expect that Social Security won't be there when we retire? That's answer choice A. What about B? Do you expect that when you retire, Social Security, your benefits will be less than half of what current retirees with similar earnings history receive? Or do you think C, your benefits when you retire will be somewhere between a half to not quite as much as what current retirees receive? Or do you think D? Do you think your benefits when you retire will be just equivalent or maybe even greater than what current retirees with similar earnings history receive. That was the basic question that was posed in the New York Times. And so I just raised this issue because I think the public sentiment, I think, happens to be that most people will answer A or B. Most people think Social Security won't be there, and that's because of this financing issue, that it's been historically difficult to finance Social Security. And so in the last part of this lecture, we'll take a close look at that financing issue to get a better sense to have a more informed, to be more informed about the possibility of whether or not Social Security will actually be there when we retire. All right, so in terms of how the program is structured, we're taking a look here at eligibility and benefits. And so we noted that Social Security is potentially available to anyone who makes the required contributions, and that contribution happens to be a 6.2% tax. It's a 6.2% tax on both the worker and the business, and it's capped. So you don't pay 6.2% on all your earnings. You just pay 6.2% on earnings up to 117. I note here this is so this should be corrected. It says here $113,700. That was for 2013, but for 2014, this capped amount is actually $117,000. Right? So you pay 6.2% up to that amount, and your worker and your business also pay 6.2% up to that amount. And so if you've made that contribution, if you've had those taxes taken out of your paycheck for 40 credits worth of credit for the program, then you qualify for Social Security. And so those credits, they're equivalent to quarters in a given year. And so if you think about how many quarters in a given year, of course, there are 4 quarters. And so doing the quick math, if you're thinking about accumulating 40 credits or quarters, that's going to take you 10 years. That's the basic requirement for eligibility. So if you've been contributing for that amount of time, you're eligible for Social Security. I want to point out that it's not just based on your contribution, but also there's a categorical eligibility requirement, meaning that you have to fall within a certain category of potential recipients. And so you have 3 basic categorical requirements. That's either you have to be aged, meaning you're age 66 and older. The full retirement age is age 66. You can claim benefits as early as age 62, but the age at which you claim full retirement benefits is going to be age 66. There's a survivor's category. You can become eligible based on that category. And so as a survivor, you can claim benefits as early as age 60. And then there's a disability component, disability category of eligibility. And if you're a person with a disability, you can claim benefits at any time as long as you've made the required contributions. And so different requirements for eligibility based on the different categorical criteria. And so just a quick note here about the benefits. We'll take a closer look at how the benefits are calculated in a second here, but just note that based on your categorical eligibility, so the category upon which you're claiming your benefit, there's also a different benefit that's going to accrue to the beneficiary. So there's the retirement benefit that has its own calculation. There's a survivor's benefit. Right? If you've qualified based on the survivor's category, you're going to have a different benefit. And then if you're eligible based on the disability category, you're going to have a different calculation there as well. Okay? And so the rest of this lecture is really primarily about the retirement benefit and the retirement eligibility category. There's more detail, the survivors and disability components that I won't. I just want to give you a glimpse into the program. All right, we're talking about the financing. We're talking about the financing of the Social Security program, and so there's a piece of legislation called the Federal Insurance Contributions Act that mandates that all workers will pay into the Social Security system, and this is what mandates the funding behind the Social Security program. This is the piece of legislation that authorizes the financing of the program. And so you'll note that under the Federal Insurance Contributions Act, or FICA, you'll notice, especially on your paychecks, right? And next time you get a paycheck, look at your pay stub, and you'll see this FICA tax. And if you look at the amount, you can figure that the amount will be 6.2% of your earned income, right? That's what's going into Social Security. And you may calculate that there's both You may find that there's both a Social Security component and a Medicare component. There are different taxes being collected, authorized by FICA for both programs. So there's a Social Security 6.2% tax for Social Security, and then there's a 1.45% tax for Medicare. Now there's a distinction. There's a little distinction here in the way the tax is collected. So in the way of Social Security, there is a cap, right? You notice that there's a cap up to $117,000, which I pointed out before. But for the Medicare portion, that 1.45% tax, that's a tax on all earnings. So it's not capped at $117,000. All earnings will be subject to the Medicare tax. Just one final note about the financing of the Social Security Trust Fund, and that's that this is a tax that's assessed on earned income. So it's not on unearned income, right? People have different sources of income, both earned and unearned, and so this is just a quick point that only earned income is subject to the FICA tax. Another further note on the financing of the Social Security system. The Social Security financing structure is what you call a pay-as-you-go financing system, right? So it's not as if people have this misconception that what we're doing is we're getting that Social Security tax taken out of our paychecks, and then we contribute to some individual retirement account that the Social Security Administration is managing for us. That's not how Social Security actually works in practice. What happens is current workers, right, when they get that tax taken out, that revenue is being used to finance benefits for current retirees, right? So current workers, in other words, current workers are paying for current retirees. So it's not a piggy bank system, as I note in your slides. It's a pay-as-you-go system, which has a different meaning than what people think in the way of retirement accounts generally. Now, just a quick assessment of the progressivity or the regressivity of the Social Security tax structure and the benefit structure. We want to be able to characterize whether this system is more favorable for the lower income worker or the higher income worker is the basic question. And so recall the terminology that we introduced before about progressive taxes or regressive taxes. Now, these terms not only apply to taxes, but they apply to general program structures. So this could we can characterize the benefit structure as being progressive and regressive as well, and that's what we'll do in these next few slides here. So first, in the way of the tax side, on the way of the tax side, if we're assessing how progressive are Social Security taxes, well, note that we said this is a 6.2% tax on earnings up to a capped amount, and so that capped amount is $117,000, is what you see here. Right? So you're paying a 6.2% tax all the way up to $117,000 of earnings, and then if you make more than $117,000, any earnings beyond that amount, beyond that capped amount, is not subject to Social Security tax, right? And so let's take three hypotheticals, right? Three hypothetical workers with three different levels of earnings or earned income. Let's say you have a $30,000 worker. That person has to pay 6.2% of earnings, right, into the Social Security Trust Fund. You have a $117,000 worker. That person also has to pay 6.2% of all of his or her earnings into the Social Security system. And so if we're assessing progressivity or regressivity up to that point, right, just up to the point of the capped amount, you would say that this is in fact flat or proportional. Right? It doesn't matter if you're a low-income worker or the person at the capped amount, $117,000. Everyone is paying the same rate up to that amount. But when you get to people who are earners beyond that capped amount, so if you have people making more than $117,000, let's say, as I note here in your slides, so if you have a $500,000 worker and we're still assessing the progressivity of the overall tax structure, note that this person will pay 6.2% up to the capped amount we noted before, so 6.2% up to $117,000. That amount calculated is actually $7,254. And so recall that beyond $117,000 all the way up to $500,000, right? So on almost $400,000 of earnings, that's almost $400,000 of earnings that escapes any sort of Social Security tax, right? That's how the structure works. And so if we're assessing the rate of tax to the $500,000 worker, we know that this person pays $7,254 in the way of a tax. So that amount, as a percentage of this person's total earned income, is actually only 1.45%, right? So while we just went from a 6.2% rate of tax all the way down to 1.45% rate of tax. And so, once again, if we're assessing progressivity or regressivity, we would characterize this as being more favorable for the higher income worker, right? The tax structure. So, so the basic question: is it progressive? Is it regressive? I think it's, as you can see from the calculation, it's much more favorable for the higher income worker who has lots of earnings here that escapes Social Security tax. So we call this a regressive tax structure. Is how we would characterize this portion of the Social Security program. Now, let's do a similar exercise here and assess the progressivity. Is it more favorable for the lower income worker or the higher income worker? Now we're talking about the benefit structure, right? Who does it favor? The lower income worker or the higher income worker is what we're assessing here. And so first we have to show you exactly how the benefit is calculated. What the Social Security Administration does, they'll take your highest 35 years of earnings. Right? They'll take your earnings history, your highest 35 years, and then they'll divide that amount by 420. And so 420 corresponds to the number of months over 35 years. What they're trying to do is figure out how much you made on a monthly basis, right, over your lifetime. They're trying to figure that amount, right? And that's called, more technically speaking, that's called the average index monthly earnings amount. They have to figure first the average index monthly earnings amount to calculate your benefit level. And so let's say you have $5,000 of average index monthly earnings amounts, right? So on that $5,000, if you made about $5,000 on average over your lifetime, over your highest 35 years of earnings, on the first $816 of that average index monthly earnings amount, or your average monthly earnings amount, you're going to get back, in the way of the benefit, you're going to get back 90% of the first $816. Okay? And so we call that the first bend point. And then there's the next bend point is at $4,917. These bend points change every year, depending on changes in average wages. And so you're going to pay on this difference, right? You're going to pay, I'm sorry, you're not going to pay, you're going to receive back, in the way of the benefit, you're going to get back 32% of earnings between those two bend points. And then finally, anything that you earn above this last bend point here, you're only going to get back 15% of that amount. So summarizing this section, right? Basically, if you figure how much you earned on a monthly basis over your lifetime, there's 3 tiers of earnings, right? Basically, the Social Security Administration is seeing your earnings in 3 tiers. And so to calculate your benefit, you're going to get back 90% of low-level earnings, you're going to get back 32% of mid-level earnings, and then you'll get back 15% of high-level earnings, is what the basic system or what the basic structure looks like. And so once you add those amounts up, that's basically your starting monthly benefit, or more formally stated, that a starting monthly benefit is also termed the primary insurance amount. Okay, and so I give you a calculation, a sample calculation to show you exactly how that benefit is determined. Note, I said 90%, you're going to get back 90%. Someone with an earnings history or an average monthly earnings, if they made $5,000 on average over their lifetime, they'll get back 90% of low-level earnings. They'll get back 32% of mid-level earnings, right? The difference between the two bend points here, $4,101. And then any earnings exceeding that last bend point, right? This person exceeding this bend point here, $4,917. So that's $83. You'll get back 15% of those high-level earnings. And so this is the calculation, right? So in total, this worker with $5,000 on average of monthly earnings will get a primary benefit of $2,059.17 is what the calculation is showing here. All right, so just to summarize here, so note that the tax structure, right? We said that the tax structure certainly is more favorable for the higher income worker because we saw how there is no tax for high level earnings. And then we saw that the benefit structure is actually more favorable for the lower income worker. Recall the replacement rates. That 90% replacement rate is much more favorable than a 15% replacement rate at the high level of earnings. And so you'll see why this program, even on a technical level, is very popular because it doesn't favor one class of workers over the other necessarily. It's more favorable for the higher income workers on the tax side, and then it's more favorable for the lower income workers on the benefit side. Okay, and so I note here in your slides that so generally speaking, the more you made over your lifetime, you're going to get back a higher benefit. But workers with the higher earnings history will get back a lower percentage of what they used to make than lower income workers. They'll get back a lower percentage of what they used to make. Uh, I'm sorry, it's the other way around. So workers with the higher earnings history will get back a lower percentage of what they used to make relative to a lower income worker who will get back a higher percentage of what they used to make. Say that about 10 times. That's not easy to say. Anyway, we'll keep moving on here. So you have the benefit, and just one other detail here in the way of the benefit. You have your primary insurance amount, or the starting monthly benefit, in other words, in layman's terms. That amount is adjusted for changes in prices every year. So if prices go up, there's an automatic adjustment in your benefit level. And so you'll notice that it's based on the Consumer Price Index. There are multiple consumer price indices, and that's calculated by the Department of Labor. And sometimes the Social Security Administration will pick the Consumer Price Index that maybe helps to save money. For example, some of these price indices, the Consumer Price Index, the CPIW, is showing a 1.5% cost of living adjustment for between 2013 and 2014. But the CPIU, as opposed to CPIW, is showing a cost of living adjustment in excess of 2%. And so a slight modification that the Social Security Administration has done recently is in picking the Consumer Price Index that shows a smaller rate of increase so that they're saving on the benefits that are being paid out. Okay, just a quick note there. All right, so this is just a quick note about potential criticisms of the Social Security program. There are going to be criticisms both from the left. I'm talking about ideology here, so both from the left and from the right. Just on a personal level, I don't know why you'd want to criticize Social Security if you're on the left in terms of your political ideology. But there are some out there noting that Social Security sort of devalues welfare, right? The fact that that Social Security recipients, they have this earnings history. This is like the Cadillac benefit that the Cadillac level benefit that the government issues, as opposed to those who don't have a earnings history. That is, the TANF recipients are sort of second tier. And so basically saying that we've devalued, through the generosity of Social Security, we've devalued TANF benefits over the years. So I'm not, this sort of argument doesn't resonate with me too much, which is why I don't stress it, but I just want to point out, just to be even-handed, that there might be criticisms of Social Security both from the left and from the right. But certainly we have criticisms of Social Security from the right. We're talking about conservative criticisms of President Reagan, President Bush. Most recently, President Bush had proposed back in the early 2000s that we replace the system altogether, that that tax that we were talking about, that 6.2% tax, that workers should be able to take out 1/3 of that tax and invest it in private accounts, but that never really gained any steam. But note that many of these criticisms actually have been taken into account by the commissions that are put together in resolving the financing crisis. And so speaking of the major policy issue, recall that in the beginning of this lecture, we had talked about the potential solvency, whether or not Social Security will be there when we retire. And so here's the basic issue. So we talked about Social Security being a pay-as-you-go system, meaning that it's dependent on the current workers, how many workers we have relative to how many beneficiaries we have. So we call this a worker to beneficiary ratio or a dependency ratio. And so look at the ratios that have characterized the program historically. So back in 1950, this worker to beneficiary ratio was a very robust 16-to-1. We had 16 workers for each beneficiary. So you can imagine the ramifications or implications for the financing of the system. We have plenty of workers putting money into the system to be able to fund the program. But look at the diminishing ratio over the years. By 2004, we were down to 3.3-to-1, and then by the projection is that by 2035, that ratio will be down to 2-to-1. We'll only have 2 workers for each recipient or each potential beneficiary. And so naturally, we have to do something. The crux of the matter is that we have this diminishing worker to beneficiary ratio, so we have to do something either on the tax side or the benefit side at some point. Okay? As currently existing, so the program will be okay. The projections are that the program will be okay through 2017. But if we don't shift something by 2017, that's the year at which we'll have to dip into the reserve, in other words, the Social Security Trust Fund. And so there are projections out there stating that we'll probably run out of the reserves, probably into the 2030s, 2040s. At some point, we'll run out of reserves, and so we have to change something in terms of either the tax structure or the benefit structure or both. And so this is what I'd like you to consider. This is going to be one of your essay questions on your final exam, by the way. But these are some of the major strategies that are put forth by the experts in terms of how we might address this financing challenge. Okay, and so note the first strategy here is about that cost of living adjustment that I noted before. So we note that the cost of living adjustment was 1.5% for this year. So the strategy here, or the proposed strategy, is that we reduce this automatic adjustment to half of what the CPI is showing. So if we were to implement this for this year, so we noted that the CPI went up by 1.5%. The strategy here is proposing that we simply adjust benefits by 0.75% instead of 1.5%, right? And so that would fix X percent of the problem, is what the projection is. This is all from the Social Security Administration, these projections. The second strategy would be to modify the Social Security benefit calculation. So currently we said that we calculate the Social Security benefits over the highest 35 years of earnings. So instead of calculating over the highest 35 years, why not calculate over the highest 40 years of earnings? In other words, extend the horizon upon which we calculate the benefit. That would tend to dilute the benefit for most workers. And so you can see that would fix X percent of the problem, approximately 23% of the financing issue. Another strategy that's put forth is in terms of the retirement age. We noted that the full retirement age, the age at which you can claim full retirement benefits, is age 66. And that amount increases by 2 months every year, and so until we reach 67. And so what the experts are saying is that we should increase the retirement age. People are living longer. People are working longer. People are healthier than they ever were in our history. And so why not increase the full retirement age, the age at which you can claim full retirement benefits instead of reduced benefits, to age 70. And that would fix 36% of the problem, or approximately 36% of the problem. And then another strategy, the fourth strategy here, is about taxing. Right? We can give out the benefits, but this is not about COLA. But once we give out the benefits, why don't we tax some of that back? Because there's some people who are claiming the benefit and still working and receiving other sources of income. So people who receive lots of other sources of income, why not tax Social Security benefits more aggressively for higher income workers relative to lower income workers? That's the strategy that's being proposed here. And then finally, the one strategy that seems to be most popular among social work students, and that's with respect to the tax. We saw how the tax is capped, and that capped amount changes every year. Why not make 90% of all earnings subject to the Social Security tax? That's the strategy that's often proposed. And so the essay question for your exam is basically picking two of these strategies and analyzing these strategies in terms of their impacts on the workers, on the businesses, and in terms of the beneficiaries. So there's a full discussion of this in your textbook, in your Donito textbook. I would encourage you to take a look there at the analysis. Excuse me. And so, yeah, that's going to be one of your essay questions. All right. So in the next part of this lecture, we'll pick up with discussion of temporary assistance for needy families. That's our welfare system.